Hello and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is Thursday, March 24th of 2022. Markets are moving. Several headlines out there. And let's talk about what we're paying attention to, so you should be too. Thanks for watching. So let's go to a housekeeping item. You might be interested to tune in tomorrow. Tomorrow morning, I'll be up bright and early on the Pacific Standard Time. I'll be speaking with Maria Bartiromo at Fox Business, not Fox News, Fox Business. You can find the Fox Business channel. Mornings with Maria. And Maria will be, I'll be on a panel sharing our latest thinking at Blanke Schein Wealth Management with Maria Bartiromo at 4 o'clock Pacific Standard Time, 7 o'clock Eastern Time. So we encourage you to tune in, and if you can't get up that early, or if you just happen to miss it because you have something else going on, quite all right. We just encourage you to tune in. We'll send up a follow-up once we get the link from Fox after that interview tomorrow morning. That being said, let's talk about what we're thinking about today and what the headlines are actually, how they're moving markets. Markets are accelerating to the upside in the close. That's a continuation of what we saw last week. We saw a rebound, more of a relief rally of sorts, once we had the Federal Reserve sort of give us their indication of what they're thinking, and that's raising interest rates and guiding future interest rates rises. And so that's good, right? When rates rise, it's not a bad thing. That means the economy is strong. Obviously, we have employment data that supports it, but right now we want to look at the market sentiment, like consumer sentiment. Those have been negative. In fact, there's a research report that we're referencing from this morning's research that shows, historically speaking, if you look at all the past sort of times in the marketplace where you've had negative sentiment build up, headlines, or even not much to be positive about, right? You're geopolitically and a few things here economically. You've got inflation, you've got energy, gas prices, consumers are down. Obviously, we have a strong labor market, and that's sort of what's holding in everything here. And that's very important. But everything over time, inflation will eat into consumers. So the sentiment, year to date, markets are down, is negative and low. And when you get to these levels, historically speaking, on a 1, 3, 6, 9, and 12 month on a go forward basis, historically, we have seen markets rally over 75% of the time on all of those data points in time. In the future, markets rally and they're positive over 75, 76% of the time in the 1 month, the 3 month, the 6 month, and the 9 and 12. Now, that doesn't mean it's going to happen. We look at history as our guide, right? It doesn't actually, history rhymes, but it doesn't repeat 100% of the time. But it's a pretty good gauge. In fact, it's been very spot on with when you look at stuff like this sentiment. Everything's negative, and that's when you want to buy. We've been putting money to work before last week's rally and putting capital to work and waiting for it. We can't ever time the bottom on particular names that we like or sectors that we like or even themes that we like. You can't time the bottom, but you can share, accumulate, and that's how you build wealth over time. Buy what you like, what you believe in, what you have high conviction on when markets are down. So the sentiment is all-time low right now. Future indication, historically, it's always been a positive for investors. Now, turning to, we got a lot of housing data, and this is an old chart. I got the chart room that I'm sitting and talking to you from here, and I just recycled an old chart that we talked about earlier this year and basically said, hey, listen, this is going to be the year for 2022 of 3 basic themes. We're going to have global interest rates that are going to be rising. We're going to have food that's going to be elevated because of energy costs, because of inflation. That's going to eat into housing, right? And housing has even gone up, and the housing affordability has gone down. So housing affordability has gone down. Inventory will potentially start rising towards the back end because now we have interest rates, right? The first thing is interest rates. And we're seeing it globally. Interest rates are rising here in the US. Obviously, the Federal Reserve raised interest rates, and they're going to do so several more times. How many? We have no idea. In fact, I don't think the Fed knows. They said live, which means wait and see. I said, but it comes down to as the consumer feels the pressure because of food, energy prices, and housing as that goes up and persists. Now, and through all of this, as we have the S&P closing today, it's above a key technical level. So now we saw from a technical perspective, the S&P, all the charts, S&P down, the NASDAQ, all broke down for the first 3 months of the calendar year this year, and they broke key technical levels. The 50-day dropped below the 200-day, and that's basically not a good sign as it relates to markets. But now you can see some sort of reversion to the mean. You can see now markets are being more constructive, and the S&P is closing above the 4,500 level for the S&P 500 today, which is above the 200-day moving average. And that's this first step to have the sentiment change, the momentum or the trend change. And that started with the 6% bounce last week in the markets after the Fed meeting. So we have some constructive, positive momentum building right now in markets. We have quarter rebalancing in the last few days of March here, where foundations and institutions have to put money to work, and that's going to the equity market. That's another reason why we're seeing a bid right now in the equity market between now and calendar sort of March 31st, first quarter end date. And then beyond that, we're going to have now earnings seasons, the first quarter earnings season. But I think it's going to turn out quite nicely because corporations are growing on the top line and they're managing their expenses in the bottom line, and they're also going to report better than expected. Why do I believe that? Simply because so many CEOs and CFOs spent the last quarter, 90 days, downplaying their book and talking down their numbers. Managing expectations is no different than when Jack Schein says, Mom, Dad, I really didn't study for that test. I really didn't feel good about that test. So in our mind, we're managing, oh no, we're going to have to do some extra homework club for Jack. But then he comes home with an A and he exceeds our own expectations. I think he kind of played a game with us on that. And we like those are upside surprises. So that's a little analogy in the Schein household for you to realize what corporate America does. The same thing. It's no different than 7th grade, guys. It's what they do, and that's how they play the game. So we could see some upside surprises, earnings estimate exceeding expectations. We could also see what's most important. This is the bid that we believe could play out in the second quarter. Corporations are going to look for ways to reinvest their excess cash flow, those companies that are making money. We like those companies. What are they going to do with it? Well, they're either going to kick out an extra dividend, raise their dividend, which is great for our cash flow minded investors, or buy back their shares, right? Take out their shares on the basically common in the open market, which also helps the stock price over time. Now, if we see buybacks meet or exceed what we saw last year, we have a huge opportunity. Last year was an all-time high for share buybacks for corporate America. We believe that we will meet and exceed that, and we're going to listen to that in the quarterly conference calls, because corporate America will actually be allocating capital in their own companies and reinvesting that. And that ultimately becomes, hey, it's great for shareholders long term. So as long as we be patient, we wait for quarters end, we do some rebalancing as we're doing, we're positioning accordingly, putting some money to work, dollar cost averaging our way in, and companies that we like, taking advantage of the markets that are down, but also keep in mind the key trends that are a backdrop of 2022. So thanks for watching again. Tune in tomorrow morning. I'll be on with Fox Business, Maria Bartiromo at 4 a.m. So I'm going to leave right now and get some sleep. Take care and have a great day.